You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Jordan Wrong, who is the co-founder of Predicting Alpha. He's won the largest options trading competition in Canada, I believe twice, right? And
Yep.
He also runs a seven-figure fund dedicated to trading options and volatility. So first off, thank you so much for being on the podcast, Jordan. It's awesome to have you here.
Srivatsan, it's great catching up with you, buddy.
Awesome. So Jordan, could you share a little bit about your background, how you got into finance, and your journey to where you are today?
Yeah, sure. So I think like a lot of retail traders, we start out with maybe reading a Warren Buffett book or, a book on value investing. My dad always had BNN, which is like in Canada, the Business News Network, playing when I was a kid. And so that's really how I got started, right? Just, seeing this every day coming downstairs and having, someone talking about stocks and how they're making all this money in stocks is really what piqued my interest in and how I got started. And then from there, I just started reading, the classic books that I guess every retail trader starts reading when they first get in.
And you sort of, in university, I believe you studied economics or something, right? You did not study, say, statistics or mathematics or something, or get a PhD of some sort. So how did you actually go about becoming a quant without having a math background or a PhD background?
Yeah, so actually, I was actually right out of high school. I was an electrician for a bit, and then had a serious accident on my hand. Had like 12 stitches there, and I was like, this is not for me. And went back to school for financial economics, which is a little bit math intensive. And from there, it's just, getting into quantitative finance. I want to first say is quant is not like, AI or machine learning or, all these fancy words that people talk about. It's really just putting numbers to your idea, right? It's trying to be a little bit more objective and less subjective. And I think every good trader kind of finds their way towards quantitative finance, just because it's really hard to make money subjectively.
And when you talk about that, me and you have had conversations on sort of technical analysis, and you have sort of a story to share about how you use technical analysis and how you made the shift from technical analysis, so following like chart patterns and stuff, into quantitative finance. So could you talk a little bit about that? Number one, how you got started with technical analysis, and when you found what made it click that at least for you it doesn't work, and you made the shift to quantitative finance.
Yeah, sure. Like there's a super easy barrier to entry or super low barrier to entry to come into technical analysis, right? You can go and pick up a book, and some guy's telling you that, hey, this falling maple leaf pattern works. I think, as Ewan Sinclair calls it, the falling maple leaf pattern. There's all these types of patterns that you can see, and once you start seeing it like in real time, it kind of feels real, right? It's like, oh, I am seeing this ascending triangle or this bull flag, and as humans, we see patterns everywhere, right? We see patterns all the time. So when you first start trading technical analysis, it feels like something that you're magically seeing that maybe not everyone else is seeing. And there's a really good story behind technical analysis, right? This thing's breaking out on high volume. It means the banks are coming in, and you can, jump in front of them and ride that wave. But quickly I found out that this is faith-based, right? This is what I call like faith-based trading. Someone in a book told me, hey, there's this pattern here and it works. Or some guru told me, hey, there's this pattern here and it works. But I didn't really know if it worked. Right? It was kind of like faith, right? I believed in it. And you can only trade the head and shoulders pattern for a certain amount of time before you realize like, hey, this is not working for me, right? So I found someone, his name's David Aronson. And what he said was technical analysis is not bad, right? It's the subjective technical analysis. When you start being able to test these ideas, it becomes objective, right? And that's what he called evidence-based technical analysis, right? Which is quantitative trading. So I kind of transitioned over into that area afterwards, after burning my hand quite a bit.
I mean, I remember you said that you went on vacation to Portugal, I believe, trying to trade technicals. And
Oh man, yeah, dude. It was like, well, I'm 18 or 19. And I said, you know what? There's too many distractions here. You get friends calling you. So I was like, let me take like a 2-month vacation and just go somewhere where there's a beach and I can just study technical analysis. And how could I not win? If I spend all this time learning about this stuff. And obviously it didn't work out quite as well as I expected it to.
And one of the things you mentioned at the start was that today you could just pick up a book on technical analysis. You could probably find a free PDF online. So sort of the information is very democratic. But do you think that, at least in your opinion, say if it was the 1970s or the 1980s, you would have been successful as a technical analyst? Sort of the heyday of people like Paul Tudor Jones, Bruce Kovner, the Commodities Corporation guys. I know they were they majorly focused on a lot of these technicals. So do you think that, if it was say 40 or 50 years ago, you would have been more successful using technical analysis? Or do you think you would have still found your way towards, focusing on, the quantitative stuff?
Well, I'm only 25 Srivatsan, so it's I can't speak too much for how I was trading back in the old days, but what I guess is that information moved a lot slower back then. So trends would probably be more prominent, right? It wouldn't be priced in so quickly like it is today. Super quick example would be like post earnings announcement drift, right? That was probably there's a lot more edge in there trading that back in the day because information moves slower, right? The earnings came out, only a select few people knew about it right away, and then more people would figure out about it as it spread through through newspapers, etc. And you can actually see that on certain exchanges globally. That there are some areas where exchanges are not as efficient, and so you see these the information moving slower. So what? I probably maybe using some quantitative technical analysis. Even today, trend following was probably did much better back in the day. I would guess. I would assume.
Mm-hmm. And in today's markets, how does one actually go about finding an edge? Is it like purely focused on back testing and coding? Now, how would you go about finding an edge?
Yeah, the way that I trade, Srivatsan, is like, where is the market? Where could the market be inefficient, right? Where might there be someone willing to give up money, right? Or maybe someone not understanding a product properly, or maybe there's some regulations that are causing this inefficiency to be there. Maybe there's a size barrier where if you're too big, you can't trade it. So the way that I really think about it is, where in this world might there be an inefficiency? And then I start to look in those areas and use ideas and other concepts that I've learned from other people or other areas in the market and apply them to areas that might be less efficient.
And since you focus on sort of options and volatility products, what is it that makes the options and the volatility market as a whole very inefficient?
So I wouldn't say it's inefficient, but the reason why I love volatility trading is because of the dimensionality, right? You can do so many different types of things when you're trading volatility. It's not one dimensional. Like, let's say buying and selling a stock, right? And so that's what makes it really unique and really exciting is you can, let's say, recreate certain products using certain things, right? So for example, let's say you want to create the S&P 500, right? you can go and buy all the components and to recreate the product. And in volatility, you can also do the same, right? It's like, what's the difference between a call and a put? Shares, right? If I own a call option and, I sell shares, then I create a put, right?
Yeah.
So, being able to have much more products available to you and to be able to recreate things and find these inefficiencies, it makes it really exciting.
And so, so what kind of strategies do you personally implement in the options market in order to take advantage of, these possible inefficiencies, these edges?
Yeah. So, I try to do a lot of different trades, right? There's a lot of different products that you can trade out there, but most of the stuff, Srivatsan, I would say is relative value based. So, given one product, what should another product be trading at, right? And if there's, let's say, a dislocation between them, I'll either do one of two things, where I will, either buy the alpha leg, right, or trade them as a basket. And the way you can think about it, Srivatsan, is like, let's say you have the S&P 500 and the NASDAQ. And these products are going to be pretty efficient. But let's say, for example, they're not efficient. And there's a lot of liquidity being driven into this one product. And so you could, for example, come here and let's say sell vol on this asset and buy vol on this other asset, right? And kind of offset that, your risk there, right? You're transferring that liquidity from one product to another product and hopefully getting paid for it.
Is this sort of like a version of stat arb or statistical arbitrage where you find correlation between two products and you try to trade it?
Yeah, definitely. Definitely. Or sometimes you just can recreate the product. For example, let's say we're looking at a stock and it has a 4% dividend. Okay, it has a 4% dividend yield. But you notice that you can create the stock with the options, right? Let's say buy a call, sell a put, and there's no dividend being priced into this, right? Now, obviously it's rare you're ever going to find something like that, but that would be an example where now you can just capture the dividend, right? You can find these kind of like unique edges, and there's tons of them when you start looking at a broad range of products.
Right. And now, I wanted to go a bit deeper into options. So, if someone wanted to, become an options quant, how much math or how much mathematics do you really need to know to be successful, as a quant in the option space? So, if you go onto, onto the community, volatility, trading community on Twitter, you see that everyone's got, say, a math PhD, or they're doing a PhD in physics, or something crazy. And if you pick up sort of the more arcane books on options, say something that focuses on trading the skew, or something that focuses on tail risk hedging, and it has all these fancy Greeks, or these fancy models or calculus or whatnot. So how much math do you really need to know to be successful as an options quant?
Mm-hmm. I don't think you need to know that much. I think you shouldn't be illiterate, right? But you don't need to know as much as maybe what's said on Twitter. For example, I'll be someone to tell you that I've read a lot of Eugene Sinclair's work, and most of the time I'll skip over his math stuff. But but there's certain formulas, right, that I need to understand. Let's say, for example, I'm trading the implied move for an earnings event, right? You really want to understand what's going on in that formula, because if you want to make some tweaks to it. So you can't be illiterate, Srivatsan, but I would say you don't need to be a mathematician. You definitely don't need to be a PhD. The good news is a lot of the work has been simplified for you, right? So for example, I code in R,
Mm-hmm.
and there are some models that I find, help me out a ton, but I might not actually know all the derivation happening behind the scenes. I just know enough to understand what's going on and how I can use it going forward. But I really don't think that you need, you need a math PhD or even to be extremely or really well versed in math. You just need to be literate. Statistics is important.
Got it. And could you give an example of the models that you just mentioned and how you actually go about using it?
Yeah. So, in trading, we're trying to forecast, right?
Right.
We're trying to forecast the spread, or we're trying to forecast, tomorrow's return. Sometimes we're not trying to forecast, but we're just, let's say, recreating a product, right? We're just trying to, model it and say, okay, how much is this worth given all this other stuff? But when we're forecasting, the way that I go about it, Srivatsan, is I usually have a data set
Mm-hmm.
and I have a target variable. So I spend a lot of time on this. I spend a lot of time on, okay, what am I actually trying to trade? And you do some transformations to it. Let's say you make it stationary, or you remove time varying volatility. And then you have your candidate variables, right? And those are, you're trying to use, these variables out there that try to help you predict what's going to happen. So example, earnings trading. Okay. I'm trying to predict tomorrow's volatility, right? Tomorrow's price movement, given a whole bunch of candidate variables, maybe how much volume there is right now, or how dispersed the analysts are around the earnings event. What's the average move for this company? So you have these variables, and you try to forecast loosely, right? Because there's so much noise in trading. The target variable.
Got it.
Yeah.
So how do you go about identifying overpriced variance risk premium? And for anyone listening, variance risk premium is the tendency of the implied volatility to usually be overpriced or to be over the realized volatility. And how are you able to exploit such opportunities? And can you give us a few examples?
Yeah, it's trading risk premium is going to have a lot more variance than, let's say, trading inefficiency. And the way that I usually approach it is I like to say, like, okay, who's buying here? So let's say, for example, I'm selling vol.
Mhm.
I want to know who's buying here, right? Why they're buying, and most importantly, who's selling and why they're not selling, right? So if let's say we're seeing huge vol come in, or huge buying pressure coming into volatility on a certain name, I want to know who's there, right? Who's buying that stuff? Why is there a lack of liquidity providers, etc. And you see this because this is really important. Like, really understanding who your customer is here, who your client is, I think is very important when you're doing these types of trades, Srivatsan. I've seen so many times where vol picks up quite a bit in a name, and you don't know why. And I've seen so many times where you go and try to sell that, and next thing you know, the company's coming out with some FDA approval, or it's a merger, right? Knowing, I like to look at like a retail sentiment, because knowing that there's a whole bunch of retail coming into a specific name, and it's hyped across a lot of the boards, I'm going to be much more inclined to sell that vol, just because on average, right, retail is using it as a delta bet, where I'm trying to look at it through the vault lens. So they're going to be overpaying on average for that delta exposure.
Could you give us an example of where you traded an overpriced variance risk premium, or traded overpriced variance risk premium, and how you exploited that opportunity?
Sure. So I think actually one of the questions I saw, one of your followers on Twitter asked about GME.
Yeah.
I was actually short GME vol when it was rallying from 40 to 50. And I cut that quick, thank God, because a few days later, the thing gapped up to 200, right?
Mm-hmm. Yeah.
So that was a time where it didn't work out, but I came back in when the stock was trading about $300, and I could sell the Jan 2023 straddles for $350 at the money. And, within 2 days, that was trading at $200 or $250. So I guess those are two examples of, where I kind of tried to get, try to find mispriced volatility, where I thought the vol was overpriced, right? The risk premium was overpriced.
Got it. When you at the start of this interview, you sort of mentioned that the option space gives you a lot of freedom to structure trades as you want, and making it structuring it so that it fits your needs. So could you sort of explore, could you sort of give our listeners some tips on how to structure their trade so that they're able to focus on a specific opportunity? So for example, recently you shorted the Jan 2023 strato when you traded GME. So could you sort of explain sort of the thought process that goes behind that?
Yes. So a good trader there's going to be two big parts to every good trader. And as they get better, these two parts get better. The first is, do I have a good thesis? Okay. So the trade idea, right? That's important. That's very important. And you get better at that, through time. But the second part, Srivatsan, is picking the best structure to fit that specific view, right? So if I think, someone comes to me and says, hey, I think the S&P 500 is going to go up, right? Well, with options, so in that case, Srivatsan, you can just buy the stock, right? Or let's say buy a digital, a tight vertical spread, right? A tight call spread. But what if the person says, I think the S&P 500 is only going to go up 1% over the next week? Well, now we're adding this volatility component to it now. And we could say, okay, well, if I buy a call option, how much do I make? If I sell a put option, how much do I make? And if I buy a stock, how much do I make at that, specific, for that specific thesis? And picking the best structure to match that thesis is crucial, right? So, and that's the beauty of options, right? Is you can actually customize a specific trade to match your specific view. And the better you get at picking, a good structure to match your thesis is you become better as a trader. And I would actually add to that as well, Srivatsan. You don't want to be the electrician going around with a Robinson screwdriver everywhere. You want to have the tools on your belt, right? And if this guy needs something done here, you're able to, let's say, pull out a saw. And if this guy needs something done over here, you're able to pull out a drill. And you know exactly which tool fits best for each job, right? And I think that's super important as a trader.
Got it. Could you also explain sort of how you source ideas or names to actually trade? So for example, you mentioned GME, but there's the some short squeeze like GME does not happen every single day. It happens, once every few years, for example. So how do you go about actually finding opportunities and ideas regularly to trade them?
Yeah, it's a really good question. So when it comes to trade ideas, there's a few things I do. So like I said, I try to think about, okay, well, where might something be in this world be over or underpriced and why? So for example, I might look at, let's say, liquidity features, right? Or for example, let's say for earnings trading, it's likely that earnings vol on average is going to be overpriced, right? And the beautiful thing about let's say earnings trading is there's a bunch of bets you can do, right? Selling volatility, for example, is not a golden bullet or silver bullet, but when you diversify it across multiple bets that are actually, they're actually diversified, you can start, building out a strategy. So in terms of finding good strategies, Srivatsan, I would say it's, talking to people, having my ear to the ground, listening, it's really a bunch of thing. And, so I would say, yeah, just listening around and seeing, what could be mispriced or what could be, over underpriced. Another example, actually, Srivatsan, here I'll share with you is the whole Tiger Cub blow up, right? So I was short vol on the basket of names, TME, Disca, GSX, Viac, right? And that's just from, listening, seeing what these should be priced at, and then going about finding a trade there.
Have you ever tried actually building, your own options pricing model? Just curious.
No, I have not. I love using the Black-Scholes model. It does the job that I need it to do. I'm not going to be trying to tinker with, with all those outputs there or the inputs. I have friends though that that work at large desks, and they, of course, for hedging purposes, will find a better model. Or if they're working on the exotics desk, right, they're probably going to be having different models to help them with hedging, specific, most importantly, with hedging.
In your pinned Twitter thread, you mentioned that you use leverage when you are completely sure that an edge exists. So what's the most leverage you've ever used, and what sort of your confidence criteria you have for using a particular amount of leverage?
Yeah, I remember I got some heat on Twitter for this. I bet pretty big. Like, there's some trades where I've had quite a bit of risk on the table. For like a quasi-arb trade. So, when I say quasi-arb, it's like, it's almost an arbitrage, but it's not. There's some other, there's slightly other, there's some slight tail risk, right? So you try to cover those, but for certain trades, I bet like 70% of my account on a single trade. Yeah, and I'm probably going to take some heat for that. But the way I think about it, Srivatsan, is like, look, if you could buy gold on, let's say, the U.S. exchange, and sell gold on the Mexican exchange for two different prices, right? Or let's say, you buy the S&P on this exchange and sell the S&P on another exchange. How much would you bet? How much of your account would you bet? Or you bet it all? Right.
I mean, it's sort of like an arbitrage. So yeah, I get it.
Right. So if your edge is so big, you need to scale to that. You need to bet big. I hear all the time, like, don't bet more than 2% of your account. But it's like, okay, if you have a serious edge, you got to bet big, right? And most of the guys that I know who've made a lot of money in this game have been right and added a lot of leverage.
And when it comes to sort of a regular options position, so when you're just finding overpriced vol to trade, and it's not a quasi-arb position, it's not a quasi-arb kind of trade. How much would you go about betting? How would you manage risk when it comes to those kind of trades?
It's going to be different for each one, Srivatsan. For the
Do you have any
GSX
guidelines or something you can share?
Yeah. So sure. So for like this this basket, for the Tiger Cub basket that I was a short vol on all of them, I had 1.5%. I was in the Jan 23s and Jan 22s, and 1% of my account of Vega. So let's say I had $100,000 account, I would have just over $1,000 of Vega. So usually the way that I think about it is, don't have more than 1% of Theta, and don't have more than 1.5% of Vega, is what I usually go by.
So I wanted to get back into trading options, and one of the things that you do is you trade earnings very regularly as an options trader. And to most people, trading earnings tends to be a gamble, because you sit there and you're trying to guess what the earnings is going to be. And people usually tend to buy calls or puts depending on whether they think they're going to beat or miss earnings. But you trade earnings in a completely different way. So could you explain how you trade earnings as a quantitative options trader?
Yep. So you have your target variable, right? Your target variable is, in my case, for example, is going to be the size of the move, right? Or the straddle P&L. So, I played around with a couple, but we'll talk about the size of the move. So you're trying to forecast the size of the move tomorrow, right? Or, the distribution of all the outcomes for tomorrow, right? How wide is that distribution for this particular stock going to be for tomorrow's event? Find, such a slight edge, right? Because the thing is, Srivatsan, we're going to have, 500 bets you could do this season, right? So you have 2,000 bets a year.
Mm-hmm.
So you don't need this huge edge. You need to find something that is significant, right? Let's say an R squared of 3%, right? That is going to be big enough for you to be able to make money. And so, basically the way I go about it, Srivatsan, is just like we talked about earlier today, right? It's find how work on your target variable. Pull in a whole bunch of data and really spend time on this data set. Figure out what your target variable is, spend a lot of time there. Then try to figure out, okay, well, what candidate variables can I add to this to make this to be able to predict tomorrow better. And, we always hear about like neural networks, AI. It's not really about that. It's not really about that. It's about, can we find good indicators? Can we, do some feature engineering to try to figure out what are good features or good variables that we should have in our data set to predict, the returns tomorrow. And that's where I spend a lot of my time, just, trying to get a good data set going, and then using simple models, simple techniques to try and find a small edge.
Yeah, as you go back to the concept of models, so I was curious, so how nuanced do your models have to be? I mean, you say simple, could you define what simple means? Because, simple in the quantitative space could be very complex to the average person.
Yeah, dude, so I keep it actually very simple. So I try to make things linear as possible. So I'll transform my variables to try to get them linear. And besides that, honestly, like the certain, I use very simple techniques in terms of, okay, can I normalize my data, right? So can I make sure everything is on the same axis or the same, on the same scale, right? For example, something like if you're looking at earnings, well, a 5% move in Coca-Cola is way different than a 5% move in Netflix.
Mhm.
So I'm gonna have to scale it so that a 5% move is a 3 standard deviation move for Coca-Cola. And let's say a 20% move is a 3 standard deviation move for Netflix, right? So you want to get things on the same scale, and then just simple models. I mean, just really looking at your data, really understanding your data, trying to take out the structure. So for example, you might have a distribution, and inside that distribution is many other distributions, and trying to like strip out what those are, right? And it's mostly, exploring your data and really getting to understand your data that are used out there.
You say that last bit again, I think got cut out.
Yeah. From where? Starting from where?
So you say you're talking about you should really understand your data.
Right. You should really understand your data rather than, using all these fancy models, right? Simple linear. I mean, sometimes it can't be linear. So you can use other types of models to help with a little bit of curvature, but you want to transform the data usually to get it linear if you can, so you can really understand the model. That's important too, Srivatsan. Actually, I'll make a quick touch on that. When you're modeling and trading, having that experience to find out what good variables should be added to the model is what makes you a good forecaster, in my opinion. Right? It's the reason why a whole bunch of engineers just don't come into this space and make a ton of money. Right? It's that domain knowledge that can really speed up the process and get you some good variables.
So, before this, we were talking about earnings, and, I'm guessing I'm jumping around a lot here, but what about earnings ensures that, the stock tends to move the same? Because sort of the edge that you trade is that, the move after earnings can usually be either overpriced or underpriced, and, you trade based off of that. So, what about earnings ensures that the stock always moves about the same in terms of absolute magnitude after earnings?
Are you trying to take all my secrets today, Srivatsan?
Exactly. It's the point of the podcast.
There are certain characteristics about about companies, right? So for example, if we really think about it, Coca-Cola, and let's say what's a really volatile one, Srivatsan, that you have in mind? Tesla, right? There's a reason why Coca-Cola doesn't move 6% on earnings, but Tesla moves that no problem, right? And so trying to figure out what it is, right? And now you can kind of say, okay, well, if I see this feature here, now I can kind of say, well, other companies like this that have this feature are going to have, let's say, larger moves or smaller moves. And there's tons of features. It's not just one simple thing. And so, being a good data scientist and trying to figure that out, there's quite a bit of money there.
Could you give us an example of a consistently exploitable risk premium and how that's different from trading a simple inefficiency.
Sure. Sure. It's tough sometimes, right, on these podcasts, because like you don't want to, you're trying to beat around the bush, right? Because you can't really, you can't really give it all. So when you think about the risk premium, Srivatsan, you're trying to think like, okay, well, where am I going to get paid for risk, right? Let's say if I'm selling convexity, right? If I'm selling a straddle, well, there's a chance of a huge blowout,
right?
So I should be compensated for that risk, not all the time, but I should be compensated. And trying to find areas where, let's say, that risk premium is more expensive is going to be important. And I think really understanding the client, who's really bidding it up here, can help with that, right?
Absolutely.
But some ways to measure risk, variant risk premia is, or let's say when you're forecasting, is what is the current implied vol, and then what do I think realized vol is going to be in the future, or what do I think implied vol is going to be in the future, and that spread, right, is what you're really trying to trade. And then I guess, sorry, yeah. And then you were talking about inefficiencies there. And inefficiency is going to be pretty blatant, but usually, and this is where I've had so many problems with this. Like just recently, for example, one of my bank accounts got closed because I was doing sizable wire transfers, and they didn't like that, right? So it's going to be hard to take advantage of. That's the thing about the inefficiency. It's usually going to be capacity constrained. Okay, so you can't come in there with tons of money, and it's usually going to be hard to take advantage of. Okay, low liquidity, regulatory issues, stuff like that.
I mean, it's right. That's sort of like true for all markets, because for example, you'd probably be able to find something that's really cheap, but it ends up being on a stock exchange in, say, Hungary, where there's no real volume or no real liquidity, and it seems to be true across all markets in a sense.
Exactly.
Could you also explain, what dispersion trading is? Because it's the sort of trading, I believe, correlations using options. Could you explain, what that is, and just touch up on how you run dispersion strategies?
Yeah, so I don't run too much dispersion. I usually do more relative value. Maybe we can chat on that later. But dispersion trading is basically, and let's say the ETF and the ETF space is, you have an ETF, and this ETF holds a bunch of components. Okay, let's say it has Apple, Microsoft, and Google. And you try to recreate that basket with the components, and you buy the vols on the components usually, and sell the vol on the index. But where it gets a little tricky is what happens when you have an index with 500 stocks, right? So we try to do some methods and techniques that say, okay, these stocks, let's say 5 stocks, explain the most variance in this ETF. So I'm going to go out and I'm going to try to recreate it if I can for a cheaper price, buy the vols there, and sell the vols in the index. The edge is very thin there these days. And it's usually pretty, I would say it's pretty difficult for a retail trader to take advantage of.
Right. So, so I also wanted to ask you, could you give an example of how you've exploited a relative value opportunity, and what's your process for actually finding such trades?
Yeah. So with the relative value, Srivatsan, you're basically just taking liquidity from one area and then giving it to somewhere else. You might have one ETF where volatility picks up like crazy, and this illiquid ETF that has very similar components, the vols aren't moving. So what I'm going to do is I'm going to go transfer the liquidity from this product and put it into this product by, let's say, selling here and buying here. You can even think about it in the value space, right? Where you're buying, let's say, the cheapest stocks and then selling the most expensive stocks, right? It's not very, I would say it's a simple concept, but it can be pretty difficult to take advantage of because how your risks change, right? Well, if let's say the stocks start going up, well, how do I start hedging this now? Now, at first, let's say I was delta neutral and theta neutral, and now I'm not. Okay, so how do I start hedging this? And that can kind of get a little bit tricky. But other than that, that's basically what it's all about, is just transferring liquidity from one area to the next.
Absolutely. So it's sort of like, so could you give us like an example of when you took advantage of a relative value opportunity, like a real life example?
Yeah, sure. Let me think of a good one here. Okay, so there was a company, and I was buying the volatility pre-earnings. So I was holding this thing going into the earnings event, but I didn't want exposure to the non-event volatility. Okay, so I really want to isolate the volatility of this stock, of the earnings move. And so what I did was I bought a straddle on this company, and then I sold volatility on the S&P 500, right? Because my thinking is, well, if the S&P crashes, this is also going to crash, right? I'm long vol here and I'm short vol here. But at the same time, if the stock doesn't move, right, well, I'm going to be losing money on this because let's say macro vol is dropping, or the non-event vol is dropping. And so if the non-event vol drops here, I'm also expecting that the S&P vol is going to drop, right? Or let's say I'm going to make money on theta on this S&P. So I'm buying vol here and I'm selling vol in the S&P to take advantage of that. Another example was within the same stock. So Tesla recently, Jan 2023 was 78 vol, and I think it was April or May at the time was 55 vol. Right, so I bought the front, sold the back, and then the thing 2 weeks later the thing plummeted, which was very nice, right? Because you're long gamma with a reverse calendar there. So you're trying to sell something that's expensive, buy something that's cheaper, or supposed to be cheaper. But sometimes, man, you get screwed on both legs, right? That's the worst. That's the worst when it happens. Correlations break down, or this didn't move the way you're supposed to move, and next thing you know, you get really screwed.
Yeah, and you brought up two terms there that I can't stop myself from asking. But I believe before on Twitter, your bio used to be one man's data is another man's gamma, or one man's gamma is another man's data. So number one, could you explain what that means? And number two, when we've talked off record, you've sort of explained that it's gamma what kills you. So could you explain, why, what gamma does in order to kill people?
Yeah. So I actually ripped that off from one of my friends, but I love the saying, right? One man's data is another man's gamma. You have people, let's say in the retail space, that say, hey, I love selling vol because I get to collect this data, right? But you're receiving that data because you're giving someone else the opportunity to earn if the thing blows it through the roof, right? It's like one thing I've learned in the market is nothing is for free. There's no free lunch, and if there is free lunch, if you're probably biting into a rock, right? It's not a real free lunch. And so that's really what it means is that one man's data, right? Collecting that premium, or collecting that decay on the option, is going to be someone else's gamma, right? They're inverse to each other, and that person on the other side is saying, hey, I actually think this is actually going to explode, right? This thing is going to move quite a bit, but the person selling the option is saying, I don't think so, or whoever's long theta. So that's really what it means, Srivatsan. It's not it's not too deep.
Also, on Twitter, there was a question which went, so recently on Twitter as a whole, we've seen a lot of talk about sort of the fixed curve. So how are you thinking about future fall regimes? Do you think that the front month fall premiums are deceptively cheap, or long dated is too expensive, or neither? And do you think that there's been too much of a VIX crush in recent months?
Yeah, I don't think I'd ever be popular on Twitter, Srivatsan, because I don't talk like I don't look at the at the index too much, right? I'm usually looking at things that are less efficient. I use the index as a benchmark, right? Where I think, hey, listen, this thing is pretty efficient. You got some of the smartest people in the world trying to price this thing, so I'm going to use this as a benchmark for other products. In terms of the VIX getting smoked recently, right? Coming down from 22, people saying, hey, 20 is the floor, right? I'm sure you saw that. 20 is the floor. The reality is we're just coming off of such a high vol regime, right? And so if you look at the grand scheme of things, or let's say, just prior to COVID, 16 vol was extremely high. So, I can't really opine on where I think the VIX is going. I haven't looked at it too much, to be honest. I haven't, tried to forecast that too much. But I wouldn't be surprised if VIX continue to bleed, right? I think on the S&P, I saw realized vols were 11. I wouldn't be surprised if I saw that continue to bleed. What do you think? What do you think VIX is coming down more?
I don't know. I'm not a fall trader, so I have no clue. And another question that I got on Twitter is, do you think that there are any aspects of quant as a whole, like quantitative investing or quantitative trading as a whole, that's disregarded or not used because people think it's overall too simple? Do you think
I
that
think it's the opposite. I think it's the opposite, Shrivas. I think people they try to use all these fancy models, and it doesn't really take them anywhere. I think there's a huge difference between, maybe not a huge difference, but an important difference between, let's say, someone in academia and someone who's a practitioner, right? I'm just trying to make this work. I don't need to know, all. It doesn't have to be perfect. My edge should be big enough that if it's not perfect, I should still, be able to make money.
Yeah.
Right. I'm not trying to, I see sometimes people talking about trading the Delta 5s. The options that are way out of the money, and they're saying, hey, this vol is overpriced, due to my because my model is saying it should be cheaper. And I'm saying to myself, well, does it really matter? Like why are you trading the Delta 5s or the Delta 3s? Right? Like, sure, the option's trading for 8 cents and you think it should be worth 2 cents, right? So I'm really trying to focus on, does this model do its job? Can it simplify the world for me? And then if it can do that and I trust it, then I'll use it. So I would think it's the opposite, Srivatsan.
Right. When people build models, so how do you exactly test those models? Do you just plot, your model's predictions versus what actually happened, or how do you figure out whether a model works?
Yeah. Usually I like to spin around, close my eyes, spin around 3 times, and then, come up with a conclusion after that. I don't know, in all seriousness, Srivatsan, I would say I let a lot of other smart people work on the models, and I try to interpret them from exactly. I'm not trying to reinvent the wheel. I'm trying to take their ideas, maybe make small tweaks to it to try to fit fit in my world. But in regards to, let's say, forecasting, right, building my own model to forecast, it's super simple models, Srivatsan, and then letting the computer tell me what how important each variable is in forecasting.
Got it. And to wrap up the podcast, I wanted to ask you, could you talk a little bit about what you guys do at Predicting Alpha, and how that thing started as a whole?
Yeah. So I'm sure but we were just chatting about this. I wasn't a very good student in school. I would, I'd be at the Bloomberg terminal all day, every day, right? And just skipping classes, just so I could, spend more time on the terminal. And once school finished, there was no more Bloomberg, so I had to kind of create something for myself that I could use, let's say, for volatility trading, right? I didn't see any other software out there that could really help me there. And it started off with, a project for myself for earnings, and then it started to get bigger and bigger. And eventually I teamed up with my partner, Sean, and we decided to bring a volatility trading software, to the retail traders, where it's not going to be too costly, right? And you can try and get, or you can really see volatility insights. And yeah, so you guys can check it out, predictingalpha.com. You guys can try it out for free.
Got it. Any closing thoughts?
No, I really enjoyed this podcast, and it's great. It's great seeing you again, man.
Yeah, awesome. Thank you so much for being on the podcast, Jordan. It was awesome having you.
Yeah, thank you.